If you're trading right now and feeling okay but not confident, there's a strong chance your account is already leaking risk. You just can't see it yet. Not because you're bad at trading, but because the rules you're following quietly expired, and 2026 is exposing that. And the most dangerous part, some of your recent wins may actually be hiding the problem, not proving you're safe. Here's what most traders don't realize until it's too late. Markets don't announce when they change. They let you keep trading while slowly shifting the conditions underneath you. That's exactly what's happening heading into 2026. You might still be catching moves. You might even be profitable on paper. But if your strategy depends on momentum behaving normally, volatility calming down, or pullbacks respecting old levels, then you're relying on conditions that are already breaking. And one of the forces driving this shift matters far more than the others. Most traders focus on the wrong one. From the outside, it looks like just another market cycle. Under the surface, it's something very different. First, interest rates are no longer a temporary obstacle. They've become a permanent filter. Second, liquidity doesn't fade slowly anymore. It vanishes, then snaps back violently. And here's the dangerous one most traders miss. Algorithms are no longer reacting to price, they're engineering behavior. This is why trades that should have worked now fail faster, why stops get hunted more precisely, why late entries feel punished almost personally. And in a moment, you'll see why one common habit is quietly draining more accounts than bad analysis ever did. Now let's talk about the mistake that wipes out more traders in transition years like this. It isn't bad indicators, it isn't lack of knowledge, it's the belief that you need to stay active to stay relevant. If you've caught yourself saying things like, "I don't want to miss the move, I'll just take a small position, I can manage it if it goes against me," then pay attention, because that mindset is exactly what 2026 exploits. The market now rewards patience and positioning, not participation. Trading everything feels productive, but it's usually fear wearing a professional mask. And here's the uncomfortable question most traders avoid asking themselves. Ask this honestly. How often are you trading because the setup is perfect versus because you're uncomfortable doing nothing? In 2026, that difference becomes expensive. Because institutions aren't guessing, they're building positions, defending levels, and waiting for retail traders to expose themselves emotionally. If you're trading without understanding where that institutional interest sits, you're not early, you're liquidity. And in the next part, I'll break down the exact framework professionals use to avoid becoming it. Lock this in before we move forward. The goal for 2026 isn't excitement, it's survival with clarity. The traders who protect capital now gain flexibility later. The ones chasing confirmation today usually don't make it to the next phase of the cycle. And that's where the real strategy begins. If you're still predicting markets in 2026, you're already trading at a structural disadvantage, and most traders won't realize it until their account slowly bleeds out. Not in one big loss, but trade by trade. Here's the trap. Most traders agree with what I'm about to say, and still lose money executing it. That's why this matters right now, not later. The trading framework that survives 2026 isn't complex, but it is unforgiving. It doesn't reward effort, it doesn't reward confidence, and it punishes hesitation quietly. This framework has 3 non-negotiable pillars. Miss one, and the strategy doesn't fail loudly. It erodes your capital slowly until discipline breaks. That's how most accounts die. This is where traders think they're learning, while the damage is already happening. Pillar 1. High time frame market bias. In 2026, lower time frames aren't just noisy, they're designed to exhaust you. Algorithms hunt impatience, volatility punishes speed, and traders who live on 5-minute charts feel busy, while professionals feel bored and profitable. Market bias answers only one question: is capital flowing in or being pulled out? Weekly and daily structure decide this, not indicators. If the higher time frame is bearish, most long trades aren't setups, they're liquidity donations. This filter alone removes 60 to 70% of trades that drain accounts slowly over weeks. This is where accounts bleed, not in one mistake, but in wasted time and emotional burnout. Pillar 2. Liquidity-based entries, not indicator signals. Indicators react. Liquidity attracts. Institutions don't chase price, they pull it toward existing orders. That's why price consistently moves toward prior highs and lows, equal highs and lows, high volume consolidation ranges, and session opens where liquidity stacks. This is where most traders panic and think they're late. They're not late, they're early, before confirmation. Professionals wait for liquidity sweep, market reaction, structural shift. Breakout traders feel action, liquidity traders feel control. If a move feels obvious, it's usually bait. Pillar 3. Risk precision over win rate. In 2026, volatility spikes don't ask permission. This is where confident traders blow up, not because their idea was wrong, but because size was careless. Professionals think in risk units, not predictions. 0.5 to 1% per trade. Few trades, asymmetric reward. A 40% win rate trader with discipline survives violent markets. A 70% win rate trader with loose risk doesn't survive a bad week. This isn't theory, it's survival math. The market doesn't punish ignorance first, it punishes overconfidence. Framework sequence with open loop. Here's the execution order professionals follow. Define higher time frame bias. Identify liquidity targets. Wait for reaction, not prediction. Enter only after confirmation. Exist immediately if invalidated. No revenge trading, no emotional scaling, just execution. And yet, this is not where most traders fail. They fail after the strategy, when psychology takes over. In the next part, we expose the silent execution mistakes that destroy profitable strategies even when traders know exactly what to do. This is where most accounts collapse in 2026. Most traders don't lose because their strategy fails. They lose because they betray themselves. By the time they realize it, the damage is already irreversible. Every overtraded scalp, every moved stop, every ignored journal entry quietly eats away at your account, often before you even notice. Mistake number 1, overtrading during high volatility. Retail traders see volatility and panic. I need in, now. Institutions see it and wait patiently. Mirror moment. Ask yourself, have you ever clicked buy just to feel involved, only to watch it reverse? High volatility doesn't equal opportunity, it equals punishment for impulsive traders. Every impulsive trade is invisible damage stacking against you. By the end of the week, it's gone, and you didn't even notice. Professional traders take fewer trades, stick to confirmed setups, let the market reveal itself. Mistake number 2, moving stops and breaking risk rules. That moment when you move your stop and feel relief, that's the second your system loses authority. Micro-story moment. That tiny hesitation to admit a loss is the exact moment algorithms exploit you. If you don't respect predefined risk, volatility will punish you, fast, silently, and often fatally. The fastest way to lose trust in your system isn't a bad trade, it's the one you tried to save emotionally. Mistake number 3, trading without data feedback. Most traders assume improvement until the journal proves otherwise. Future regret hook. Imagine looking back 6 months and realizing every gut instinct win was just random luck. Your account is flat, but your confidence is shattered. Tracking entry, reasoning, and outcome isn't optional. It's the difference between a survivor and a statistic. Mistake number 4, chasing wins instead of executing process. Daily profit targets destroy discipline. Algorithms thrive on impatience and they take money from it. Mirror moment. Have you ever forced a trade just to hit a number and lost before noticing? Controlled chaos. Markets punish desire. They reward process. The mental shift required for 2026. Winning isn't a number, it's a habit of disciplined execution. Accept valid losses, follow rules without negotiation, protect capital relentlessly, stay emotionally neutral. If you don't adopt this mindset, 2026 will silently take everything you thought you knew. Now that you understand where traders fail emotionally, it's time to build your actual 2026 trade setup, step by step, practical, and actionable. Most traders watch charts like spectators, hoping for magic. You're about to see how professionals actually set up trades in 2026, where every step matters and mistakes cost capital fast. Miss just one step and the market doesn't warn you. It erases your account while you debate entry points. Step 1. Define the market bias weekly and daily. Before touching a single trade, ask yourself, is the market fundamentally bullish, bearish, or sideways? If you're guessing, your account is already at risk. Mirror moment. Have you ever entered a trade because the chart felt right, only to be stopped out immediately? Pro traders don't guess. They confirm the trend on higher timeframes, then align lower timeframe entries. Trading against bias is like swimming against a current you can't see. You'll burn energy and your account fast. Step 2. Identify institutional liquidity zones. Forget indicators that lag. 2026 is about where smart money pools and hunts orders. Key zones, prior highs and lows, equal highs and equal lows, session openings, high-volume consolidations. Mirror moment. Have you ever been trapped in a breakout that reversed immediately? That's ignoring liquidity. Pro tip: wait for price to test, sweep, or react to these zones, then confirm your entry. Are you trading zones, or are zones trading you? Step 3. Entry confirmation and setup. Entry is not a guess, it's a reaction to market structure. Stepwise checklist. Price touches liquidity zone. Confirmation candle or structural reaction. Check higher time frame alignment. Confirm risk-reward ratio RR greater than 2 to 1. Mirror moment. Have you ever rushed in early and cursed yourself a second later? Wait for confirmation, and you'll avoid the majority of stopouts that destroy accounts. Step 4. Risk management, stops, and position sizing. Rule: never risk more than 1% per trade. Stop loss is non-negotiable, even if the trade feels right. Micro-story moment. That second you debate moving your stop, that hesitation is where your account loses authority. Professional setups define entry, stop loss, take profit, and capital allocation. In 2026, markets punish hesitation. One moved stop can erase weeks of disciplined trading. Step 5. Journaling and review. Every trade, win or lose, is recorded. Ask yourself after each trade, did I follow my process? Did I ignore bias or liquidity? Did I act emotionally? Mirror moment. If you're not tracking this, you're repeating mistakes invisibly. Without journaling, you're blind to your own failures until it's too late. Now that you know how to set up trades step by step, Part 5 will reveal advanced 2026 strategies that exploit hidden institutional flows, strategies most traders will never see. There's a layer of the market you almost never hear about, not because it's secret, but because most traders aren't positioned to survive it. If you trade 2026 without understanding this layer, you'll keep blaming entries while institutions extract liquidity directly from your positions. The truth about smart money in 2026. Institutions don't trade like retail. They don't chase momentum. They don't react emotionally. They engineer price movement around liquidity. Mirror moment. Have you ever seen price spike just enough to stop you out, then move perfectly in your original direction? That's not bad luck, that's positioning. Most traders think they're early. In reality, they're providing liquidity for exits. Institutional timing, when the market actually moves. Markets don't move all day. They move during specific windows when capital is deployed aggressively. Key periods in 2026. London Open, New York Open, major macro releases, session overlaps. Outside these windows, price often ranges, traps, or fakes direction. Mirror moment. If you're trading randomly throughout the day, you're fighting timing you can't see. Are you trading price or trading time? The accumulation, manipulation, expansion cycle. This cycle defines institutional behavior. Accumulation, price moves sideways, volume compresses. Manipulation, false breakout, liquidity sweep. Expansion, real move begins without you. Retail traders enter during manipulation. Professionals enter during confirmation of expansion. Once you spot this cycle, fake moves stop confusing you and real ones become obvious. Why indicators fail here? Indicators react after expansion begins. Institutions position before expansion starts. That's why RSI feels late, why MACD gives false confidence, why breakouts fail. Mirror moment. If you've ever said, "This should have worked," you were probably trading reaction, not structure. In 2026, lagging tools don't just underperform, they mislead. How retail traders can adapt without insider access. You don't need privileged data, you need patience and structure. Focus on high time frame bias, liquidity zones, session timing, and confirmation after sweeps. This alignment puts you with institutions, not against them. When you stop trying to outsmart the market and start aligning with it, consistency follows. Now you've seen the hidden layer driving 2026 markets. The final step is learning how to combine everything into a single, repeatable trading plan so you're never guessing again. That's where we finish. At this point, you have two options. Keep trading with fragments of information or lock everything you've learned into one system that protects you when markets turn hostile. Because in 2026, traders without a written, repeatable plan don't just underperform, they don't survive volatility cycles. The 2026 Trading Plan, non-negotiable structure. This is not about finding more trades. This is about removing uncertainty. A real trading plan answers questions before the market asks them. Rule 1. One market bias per day. Each day begins with one decision only: bullish, bearish, or neutral. No midday bias changes, no emotional overrides. Mirror moment. If you've ever flipped direction after one loss, you already know how dangerous that is. Changing bias mid-session is how traders slowly erase weeks of discipline in one afternoon. Rule 2. Trade only at pre-marked liquidity zones. If price is not at a level you marked before the session, you do nothing. No exceptions. No almost perfect setups. Mirror moment. Have you ever chased price because it looked like it was about to go? That's exposure talking. Every trade outside your zone is a trade without statistical backing. Rule 3. Maximum 2 trades per session. More trades don't mean more opportunity. They mean more emotional decisions. Professional traders cap activity because focus degrades under pressure. Mirror moment. If you've ever taken a third trade to get it back, this rule is for you. Overtrading doesn't blow accounts instantly. It drains confidence first. Rule 4. Fixed risk, no negotiation. Risk is decided before entry, not during drawdown. Same percentage, same position sizing, same stop logic. Micro story moment. That second where you think, it'll come back, that's when your plan must already be stronger than your emotion. One emotional stop adjustment can undo months of progress. Rule 5. Judge days by execution, not P&L. A profitable day with bad execution is a failure. A losing day with perfect execution is a win. This rewires your psychology for long-term survival. Mirror moment. If profit still defines your self-worth, the market owns you. What this plan actually gives you? Clarity in chaos, protection during volatility, confidence without prediction, consistency without overtrading. Most importantly, control. Not control over the market, control over yourself. The traders who make it through 2026 won't be the smartest. They'll be the ones who stopped improvising before the market forced them to. If you don't build this structure now, you'll still learn it later, just at a much higher cost. If this framework changed how you see the market, don't trade alone anymore. Subscribe, because the strategies that survive 2026 won't be obvious and they won't be repeated twice. Drop a comment with structure if you're done guessing and ready to trade with control.